We're gonna minimize this real quick, and what I'm gonna do is I'm gonna show you I'm gonna show you in detail why. All right, I'm not just gonna say it. Right. So we do have a uptrend. Okay, let's do one more. That we could drop it here. We have an uptrend where the market is giving us higher highs and high lows. Okay, so remember, after every higher high, market have to give you a high low. And doing a bullish trend, we only buy at the high low, right? Sorry, excuse me. We only buy at the high low because we buy from the bottom to go up. Okay, so remember, after every higher highs comes a high low. Okay, so we buy at the high low for when and if the market goes back to give us a new higher high. Okay, high low right here. So let's go ahead and generate the zone real quick. All right, these are just zones. I don't name them simply because my job is to just simply read and react. All right, so let's be more specific with this one. So, right, so this was that zone that bounced off, right? Now let's just stretch this across, right? So market broke a previous higher high to give you a new high that's higher than the previous high. When it comes to here, it gives you a high low matching the specific area where you have that double bottom, right? So you take your PA, right? You take your price action here for the buy, right? And then we place our stop loss at the last low, which is down here. Okay, so this is where our stop loss go, right? So when let's just say when and if hypothetically when you take that buy, the market instead of going up comes back down to the low point, to your stop loss, right? Guess what happened now? The stop loss is so low, it's so far away, right? If when and if the market was to go to that structure point, it will be a new setup, not just a new setup, it will be a trend reversal. All right. It is very, very rare that the market will go to the next structure point. It's very, very rare that it's going to go to the next structure point after a price action. A lot of time you do get a stop hunt where, it kind of like shoots somewhat a little bit right here and then they go up. But when and if the market comes back to this low point, guess what you have? You have another double bottom, right? You got another DB, right? So it's just a little bit of abbreviation. You have another double bottom, first one, and then there goes the second one right here. You see that? Not only just that, you have a break of structure. What I mean by that is market broke this previous higher low, right? Now, normally we have an understanding when it comes to technical analysis or market structure itself, after market break a previous high low, right? We are anticipating. Now, again, the word is anticipating, right? We're not saying that's what it's going to give us or that's what it needs to. We are going to anticipate for when and if the market goes back up to give you a possible retest for a continuation downtrend. Okay, look. So we pulled a buy, but the market fell. Not only that it fell, it went to the next structure point, which is where our stop loss goes. But when it comes back to the structure point, guess what we have? Another double bottom, right? Another possible buy setup. So, right? So now we can buy it to go back up, targeting this structure TP, and then this one, and then that one. Understanding that we just buy in the market, we're only going to simply read and react towards that. Now, again, the why is we place our stop loss at the last low because it's far enough at the previous structure point. If the market was to go to that previous structure point, it would have to be a trend reversal. Okay. It would have to be that, right? So if we have a crazy bullish trend for the month, right? And market, you got a retest here, you got the buy here, and instead of market going up, it falls all the way back down here. What do you just have? Right? You have a double bottom for a possible buy, right? Let's just say the setup was right here. Instead of, going up, it comes back to this structure point here. Now you have a trend possible reversal because it officially have broken this structure point to go back, it broke the structure point to give us this type of setup. All right. It's far enough, right? It's so far away that if market goes back to that zone or to your stop loss, it has to be a trend reversal. It's literally it's the easiest thing you can learn to do. Like once you look at it and process it, really think about it, right? You're like, oh, I understand now. Okay. Remember, just like your job, you understand you're going in for X amount of hours and you get paid for that, right? You're not thinking that because you go in early, you're gonna get paid more. Because you work faster, you're gonna get paid more. You just want to be as effective as you need to be with your job, right? Because you clock out a bit late doesn't mean you're going to get paid more. Not all job pays for overtime. And even if you get about an hour or 30-minute overtime, comes off with taxes. It's as if you never made it. But okay, so the why is simply if and when market goes back and hit your stop loss, it would be a trend reversal. Okay. All right. Now let's go ahead and cover some examples for setup itself. Okay, when it comes to placing no stop loss. So here we have a double bottom setup, right? And I created those wicks to help you understand the zone placement. Last selling candle was like so. So our zone would be something like that. And then we'll identify the lowest wick, which is the bullish candle. That will be a full zone, right? Now we have a double bottom, right? DV, right? A double bottom where market stops here, went up, and then we mark our zone for when and if, and it did, and it fell within the zone, and then we have a bullish engulfing. Okay, so we know this is a bullish engulfing because the bullish candle closed above the last selling candle. Okay, now what we do is we pull our buy, and then we're gonna look for the last low for a stop loss. Now, when you have a downtrend set up for a double bottom, so you could buy it to go up, right? You a lot of time you're not gonna have a previous structure low as far as when you have a bullish trend that comes back down to give you the retest, which is a double bottom, right? You don't have a structure as far as another high low for that lower low. So what you want to look at is the wick, right? So between the bullish setup itself or the buying setup itself and the last time market bought, you're going to look at which one is the lowest, right? So sometimes we get a wick that's like so, that will be our last low. Sometimes, right, we get a wick from either the bullish or the bearish candle that's like so, then this will be your stop loss. Okay. Now, just like before, with every setup, right? When market give us our double bottom, right? Even before the price action, we want to look to our left. Why? We are looking to our left to simply see what the market give us before, right? And so when the market give us exactly the same thing or something identical to it at current time, we know, okay, cool. Last time it did this, it bought up. When it give us just that, we're gonna go ahead and join it to buy up. That's just again our technical analysis. That's what we study. That's what we backtest. We are simply reading and reacting. All right. We're not assuming. We're not attaching no feelings to it. Okay. That's why placing your stop loss at the last low help. And that's really big on the psychology, right? When you place a understandable stop loss, less feeling is going to be involved because you understand why you placing the stop loss. There's a legitimate reason behind it. So you're not really um, experiencing the fear or doubt as much. Okay. So we pull our trigger. We would pull our trigger at the bullish engulfing right there, and then we'll place our stop loss accordingly at the last low. So if you do get these double bottom type of setup, now a lot of time I we get stop hunts. A lot of time we get stop hunts, and to interact with those stop hunts to prevent or avoid getting stopped out with the stop hunts, right? Because remember, so let me just start out there, even though I'm saying stop hunt, stop hunt. Stop hunt is pretty much when the market shoots down to go take out everybody, either collect orders or close you out. That's how they make their money. So that's why when we are doing a technical analysis, part of our rules is not just using the higher time frame, we turn the candle into the line chart. That way we understand the exact turnaround point, and then we put it right back to understand the wick aspect. So in the case of this right here, right, when you take a buy, okay, you take a buy and you go into place your stop loss. I recommend that you place your stop loss at least 5 to 10 pips away from the wick. So when the market does shoot, down, right? Right? When the market does shoot down, let's just say this right here was it. Okay. Let's just say that was a wick. That's where we wanted to place a stop loss. But the black line is where we place a stop loss because we placing it at least 5 to 10 pips away. So when the market does, okay, when the market does shoot down like so, it won't hit your stop loss. Okay. That's one way to counteract that. Okay. So again, a lot of time we don't have a previous structure, but we do have the wick to use that. Now, don't think about the money when you are trading. It is very, very difficult. I believe every single one of us go through that. It's hard not to see it because we are learning to trade to obtain financial freedom. It's just sometimes the way we go about it can make the process a lot more difficult for each and every single one of us. Now, if you just simply just take the trade, put the stop loss at the last low, and you understand, hey, look, man, out of my let's just say out of my $250, right? Out of my $250, I'm willing to risk $50. Okay. You're just gonna have to make sure, right, that your lot size from entry point and your stop loss equals $50. I know that looks like an 80, right? Equals 50. Okay. That's it. You're just gonna have to make sure, like, don't worry about missing out on X amount of pips, points, or tick. The goal is to manage and win and lose less. Increase your chances of winning by putting the stop loss where it needs to be, and then stay consistent with the amount you're telling yourself that you're willing to risk, because another opportunity will always present itself. Okay, so just like so, that's how you would place that stop loss. All right, so let's go ahead and look at another example. All right, so now this one right here, we're gonna go over at least two of them. Okay, let's go ahead and generate a zone. Right. All right, let's go ahead and talk about this real quick. So we have a uptrend market, also known as a buy market or a bullish market, right? Because it's going up. Now with a bullish, okay, with a bullish market, you will get higher highs, right? Let's go ahead and mark these real quick. You'll get higher highs. And after each higher high is a high low, okay? So each high is going to be higher than the previous high, okay? Where each low is going to be higher than the previous low. That's why it's called a high low, all right? And just like I mentioned before, doing the uptrend, your area for buy is always going to be, right? Always going to be at the high low, okay? All right? That's the area for buy. So doing an uptrend. So it's just, you know, sometimes you got to be, not sometimes, you just need to be patient and wait and let the market gives you what it is that it needs to give you before it buys up. Okay. Please remember with this method, because we are trading the highest time frame and we're waiting for the 4 hour, you can trade at least 3 different pairs or even 5. When I say trade 3, I mean by doing your technical analysis on 3, 4, 5 pairs. I highly recommend just 1 or 2. But if you want to do 3, by all means, basically you will do your technical analysis on the higher time frame. That means it will take some time before that setup is available to you. And when and if that setup is available to you, right, you will react accordingly. Now, because you're looking at um, 1 to 3 pairs, pretty much every day or every other day, one of them will have a setup. Not only just that, because you're trading the higher time frame and you're taking your trade based off the higher time frame, and you're going from zone to zone, and especially when you're taking trades off the 4 hour, putting your stop loss at the previous low. When and if market goes back to wake you out, it will be the next setup. That's why it's pretty cool to just trade the one pair. because the next setup will be available to you after it wicks you out if you didn't cut your losses short. All right, so that's one thing we're gonna go over also.